Welcome to the New Modes panel. Earlier today, we heard a lot already about AI, Gen AI, LLMs. Our challenge for this panel is to zoom in more specifically on the moat, on the elusive issue of competitive advantage. And we will try to distinguish between efficiency, a temporary edge, and a true sustainable edge, specifically in investment management. What we would like to do is to first go through very specific use cases of LLMs investment management. And then the second part, we will discuss more openly the competitive edge question. Dan, could I start with you? What do you do? And cases that really excite you about what you've seen work in the firm?
Dan Sandberg, I oversee the quantitative research and solutions team for S&P Global Market Intelligence. I usually describe the team as being like an internal client of S&P. We get to use all of the content, all of the data, all of the analytics under the umbrella, the way that we believe clients are using the content. And we document the journey in white papers. We produce coding notebooks that help clients replicate the work, and we create new products. For the last few years, we've been experimenting with generative AI, and we've been thinking about how to develop, as you say, the long-term and near-term competitive edge. It's hard to say where or when we get to a place where AI has surpassed the human contribution, but it's a very real possibility that we end up there at some point. Imagine, if you will, a world in which AI can perfectly process all information. Not just what's in the public domain, but everything behind the paywall, all the S&P stuff, all of our peers' content, everything that's available to process. And if that were to happen, if the AI were to perfectly process that information, then there would be no need to compete. There would be no longer any difference of opinion in the markets. And so at that point, competitive advantage becomes sort of non-existent. I sort of do a thought experiment, and what would that result in? And I think it's a system where those that need capital end up borrowing from the investment pool at a cost of capital set by the AI based on the risk inherent in that company. And the investor would receive a fixed rate of return based on their time horizon, their liquidity needs, the tax and other considerations that may be important to their investment process, maybe ESG constraints, for example. So at that point, we'd all be out of a job. And most of the folks listening would probably be doing something very different than they're doing today. But we're not there yet. We're not in that world today. And we have to go through a probably decade or more before we get there of AI and humans working together. We're not at this singularity market, if you will. We're not at the investing singularity where the AI has subsumed the human. We are in it together. And so the advantage today, in my experience, three things: avoiding mistakes, providing the right context, and scaling the insights. And I can give you examples of all three of those. Avoiding mistakes is about having a mechanism where if your process is stochastic, if it's variable, if it produces a generative output that is non-deterministic, then that output needs to be grounded in some sort of auditable data. It needs to track back to something that the human can verify. And so for example, we have a flagship AI platform called Pronto NLP that produces features on any document. You could bring your own document. It'll produce features for you. And what I love about this platform is that every feature has a justification generated by the AI with a link back to a direct extract from the source document. So it's auditable. That's one way to avoid mistakes. The other is, and I hinted at this earlier, to focus more on deterministic processes and less on stochastic processes. Earlier this year, we published a paper called Questioning the Answers. And what we did in this piece was we took every single question and answer in the corpus of earnings calls and we vectorized. Now, the vector embedding process is not stochastic. It's not generative. It's a deterministic process. And that vector embedding produces now a numeric representation of the text. We took these two texts, the question and the answer, we lined them up, we vector embed them, so now we're in a numeric space, and we then use the cosine similarity, which I'm sure many are familiar with. I'm not going to go into it here. It's a way of assessing whether those two vectors are close together or far apart in vector space. And what that means in a real world way is whether the question and the answer are semantically related. We've done all of that processing. We've been able to quantify and to score an executive's response on an earnings call, whether they answer sell-side questions on topic without doing anything generative or stochastic, but still using AI.
So using this example on earnings calls, I guess this is on earnings transcripts. Two quick questions. You did mention auditability and traceability, but how do you go about evaluation? How much human work is involved? Because my sense is, and from our experience in financial services, unless you really put a human to review the output, it's difficult to assess. And B, can you share briefly a bit about the technicalities of, for example, did you use some open source model, some commercial model? Like what is under the hood in this scenario?
The first question on auditing depends on the application, which is a vague answer, but I'll add context. From S&P's perspective, we're about providing features. The output of this NLP model is not a buy or sell recommendation. It's a label. And we have done what we feel to be a sufficient amount of validation that we are confident in those labels. We've produced some of those statistics, which I don't have off the top of my head. But if you were a quantitative investor and you were using this signal without any other inputs, then I would imagine that your validation process would center largely around successful and missed trades. And if you miss a trade, if your AI has steered you in the wrong direction, I would imagine you'd then try to disentangle whether you got the right output, but that output was not what was driving the stock, or whether you got the wrong output. If you're using it, and we're seeing more and more of quantamental, where you're doing sort of a quantitative feature extraction, and then that becomes part of a mosaic that you mix with other data, then you don't really need to do auditing at scale. You can look at the particular case that you're examining and dig deeper. So if you're, again, as an example, looking at mentions of tariffs and how tariffs are going to impact margins, you may be interested in a set of companies, programmatically find all of the mentions of tariffs, and then you would go and independently validate those to meet whatever downstream process you were plugging that into.